I don't think most people watching can afford that payment. Can you do one that's probably more affordable for most people, like $250,000 house? Yes, let's do it. So what we're going to enter in is exactly what our friend wants here. We're going to do $250,000, and then we are going to transition to our loan amount. Now, why you're seeing two different numbers, or really actually three different numbers here, is because when you are using a loan application, remember guys, this is a loan application. I'm not using a public site. This is an actual system that we use as mortgage brokers when qualifying somebody for a home purchase. But when you are doing an application, we have to enter in the purchase price, the appraised value, and also we have to enter in a base loan amount. Now, for now, we're just going to focus on these two, purchase price and loan amount. On a VA loan, we are doing 100% financing. There is no down payment required, so we're going to put 100% loan to value. So that's what we have there. Then we're going to come down to this section right here, which is VA info, which talks about the VA funding fee. Now, if you don't know what a funding fee is put in place on all VA loans to help fund the program. It's actually what keeps the VA loan to be able to maintain a 100% financing loan to begin with. On a VA loan, the funding fee is 2.15% of your loan amount for first time use. So what this would look like is if you were not service connected and it was your first time using the VA loan, the funding fee on $250,000 is $5,375. Now, this is not paid up front. It can be if you choose to, but I'll be honest, in 10 years doing this, I think I've only ever seen one person pay the funding fee themselves up front. But it's more than likely 99.99% of the time it is rolled into the loan. That's what most people will do. If you are using the VA loan for a subsequent time, which is really anything more than the first time, the funding fee is 3.3%, which means that it would jump up. This number should change here, and we see it now go up to $82.50. So that's what the funding fee looks like when you are using the VA loan. Now, if you have or are collecting VA compensation or VA disability of a 10% rating or more, you're a surviving spouse or a Purple Heart recipient, you are exempt from the VA funding fee. So for this situation, I'm actually going to do the veteran being exempt from the funding fee, saying that you collect VA compensation, because that's going to be what we are going to use for qualifying income anyway. And so that's also why I wanted to do that. So we've got that entered in. So now we do not see any funding fee being financed in there at all. The next thing we're going to come down to is this section here. We're going to start calculating our homeowner's insurance. A rule of thumb I like to use is about 0.55% for our homeowner's insurance. And now this is not going to guarantee you that your homeowner's insurance will be 0.55% of whatever your purchase price is. It's just when I'm doing a pre-approval, I see it sometimes be higher than that, and I see it sometimes be lower than that. So I just try to split the difference, get as close to a nice average number for that. The next part we're going to come over to is property taxes. Now, with property taxes, this is a very local thing. For example, I live in the state of Texas, where the average property tax rate on a single family home can be about 2 to 2.1% of your purchase price. Whereas I've also lived in Hawaii, where the average property tax rate could be 0.35%, which is less than half of what it is here in Texas. So property taxes are a very local thing to understand. I'm going to throw something in the middle here. I'm actually going to put right at about 1%, just for the sake of this example, so that way it can hopefully speak to most of you guys out there. And then what I'm going to do later is I will also remove the property taxes completely, so that way you can see what it would look like if you live in a state where there is no property taxes that are being charged if you are a 100% disabled veteran through what's called the homestead exemption. And then next we need to do is come down to our note rate. So the rate that we're going to use, I want to use based on whatever the national average is. So I talked about this in the last video, but I want to bring it up again in this one. If you want to see what today's mortgage rates look like, you can go over to my channel. You can click on the channel page and then go over to the community post page. There are rates that get published every single day. Today is October the 24th, and you will be able to see what's going on with rates, not just what's going on today. You can change the setting in here. You can move it around to different views. You can do it on your mobile phone as well. I'll pop up a video here for you guys to check that out and how to get to it. But as of right now, the VA 30-year fixed is right at about 5.93. So we're going to throw 5.93 in there. And then what we're now going to do is we're going to bounce over to our financial info. So now we come over here, we need to enter in all of these things. We need to enter in our monthly income, monthly assets, monthly liabilities, and real estate owned. So real estate owned, we're going to skip over. We're going to treat it as if this is your first house and the only house that you are looking at buying, and you don't own any real estate right now. So just keep that in mind as well. When it comes to income, I want to use the 100% disability so that way we can use that as our qualifying income for this example. I want to come over to this disability chart that's on the VA website, and I'm going to be looking for the 100% rating. So 100% compensation rates for 70 to 100% disability, and we have it right here, and we have it for veteran alone. So I'm actually going to use veteran alone as the number here. So the amount that you would be receiving is 38, 31, and 30 cents. So we're going to come back over here, and keep in mind, if that's not your situation and your situation is not for VA disability, I will do one with using employment income as well, because the calculation will be different. Even if you are making the exact same amount of money through an employer, it is going to be a little bit different, and you'll see why here in a second. So we're going to come over here, choose in this drop down how we are receiving our income, which is going to be VA disability. And our income was 38.31, and I believe 30 cents was the exact number. Yes, it was 38.31 and 30 cents. But because it is VA compensation, we can do a little thing called grossing up with this income. I'll show you an example what I mean by that. If I put in the 38, 31, and 30 cents here and I hit save, you're going to see our debt to income ratio is 86% for this borrower at $250,000. This is before we've entered in any debts or anything like that. What we can do now is we can do a little thing called grossing up, because VA compensation is non-taxable income, which means we get to add on 25% to that number. So we're going to take 38, 31, and 30 cents. We're going to add 25% to that, and that brings it to 47.89 and 12 cents. So 47.89 and 12 cents. Now what I need to do is come back over here to see how much exactly that equates to between those two numbers. So I'm going to subtract 38, 31, and 30 cents from that. That's 957 and 82 cents. So I'm going to enter that in right there because I need to come back to that here in a second on another screen. So 957.82. And then let's say that you have for assets, let's put 5,000 bucks. We'll call it bank. So we got 5,000 bucks as our assets there. And also, what happened to our debt to income ratio when we grossed it up? I forgot to mention that. It came down to 69%. So you saw a pretty big jump. I think before we did the math, it was actually like in the 80s, right? 38, 31, 30. Let's see what it was. So it's 69 now. Yeah, it's 86%. So it came down almost 20%. That's a lot. So that's a big jump. That's helping a lot there. Now with our monthly liabilities, let's assume, I'm just going to say that maybe you have, let's say you have 500 bucks going out, all right? Let's say there's 500 bucks in monthly debt. I'm not going to say it's a mortgage loan. I'll say it's an installment. Let's say that your monthly payment is 500 bucks. I don't know what the unpaid balance would be, but let's just say it's $10,000, $500 payment. And let's call it a auto loan. Okay, we'll hit save there. So now our debt to income ratio jumps again. It came up to 79% there. So let's see what happens. Let's see if the numbers still make sense. We still have to go over to this screen right here, which is our VA loan analysis. Now, if you don't know what a VA loan analysis is, it is a breakdown of what your overall residual income would be. Residual income is different than debt to income. You see, VA loans are not based solely on debt to income. They're based on residual income. And residual income is calculated based on a budget. How much money do you have left over after all of your bills are paid, including your new potential mortgage? So the things we would factor in here are going to be exactly as you see on the screen. Gross monthly income, proposed monthly payment, current monthly debts, monthly maintenance and utilities, which we'll talk about in a second, monthly taxes, residual income chart, and then how much the VA expects you to have left over depending on your debt to income ratio, which I will explain as well. So from the top, we have the income. I don't think we need to talk about that anymore. We already know what that looks like, and we're not making any changes to this. We have our proposed monthly payment. Now, if you were wondering what the monthly payment was based on the details we talked about, this is not a guarantee that your monthly payment will be this at $250,000. This is just to show you based on what I used as our numbers. We have our monthly payment of about $1,800, a little over $1,800. We have our monthly debts. We said we have a $500 auto loan here, and then we have our monthly maintenance and utilities. Now, with monthly maintenance and utilities, this is something that factored in based on the square footage of the home that you are buying, not the total square footage of the lot, just the living space. And this is used only for residual income. And I'll give you an example here. Let's say you are looking at buying a property that is 2,000 square feet. It's going to calculate in here that they want you to have $280 available for that. Now, again, this is only for residual income. Why this is here is so that way the VA is factoring in your potential ability to be able to maintain your property. And how they do that is based on 14 cents per square foot. So if you were buying a 4,000 square foot property, this number is going to jump to 560. So this is not a bill or a debt or any part of a monthly payment. It's only here for the residual income calculation. So I want to put that our square footage is going to be 2,000 square feet. I think a good number based on this price point. I could be wrong. And then the next thing we have is our monthly taxes. Now, because this veteran is purchasing a property using just VA disability, there are no income taxes to factor in because VA compensation is non-taxable income. But there's something that we need to include here. You see, with the VA loan, if we are grossing up your VA compensation, we can only do that to help the debt to income ratio. We cannot do that to help the residual income because residual income must be true amount. So what we would have to do is we would come back over to this screen. That's why we save it like this. This is just telling you my workflow. And we would copy over this number right here that we grossed up, and we'd come back over here. And we're just going to add it in under this local tax so that it gives us an accurate number for residual income. And you're going to see our residual income change there. So that's what that would look like. And then coming down to here, what we want to do is we need to look at what the residual income the veteran would need to have based on their household size. Now, it currently says household of 4 because I have that in there. But what I'm going to do is I'm going to change this because we said this is a veteran using just the veteran alone. Remember, for 100% rating veteran alone, it was 3831. So we're going to say that this is a household of 1. So we're going to remove all dependents, right? And we're going to hit save, and we're going to see the requirement change. So before it was over $1,000, now it's $441. So I'll just show you that chart again. I live in the southern region and I have a household of 1 in this scenario. So in this situation, the VA would want $441 left over after all of your bills are paid. However, if you have a debt to income ratio of greater than 41%, the VA requires an additional amount left over after all of your bills are paid. And the number in this situation would be $529.20. Now, how they come up with that number is they would take the 441 and they add 20% to that. That's all it is. It's $529.20. So in this situation, this veteran has $12.40 and 75 cents left over, a debt to income ratio of almost 80%. That's extremely high, but technically based on the VA guidelines, the veteran would be able to potentially still qualify. Now, there's something that still needs to happen here. The lender is going to take all of your information. They're going to take your income, your assets, your monthly liabilities that you currently have, your proposed monthly payment, your credit, your payment history that you have on your credit, and they're going to submit that into an automated underwriting system. This happens on every file. And that automated underwriting system is going to determine risk. Its job is to look at the situation at hand and what has gone on previously to determine whether or not this is a good loan or if it's a risky loan. And it will tell us a pass or fail grade. So even though you still meet the guideline, the underwriting system is going to tell us whether or not they will allow that loan. Now, sure, you've heard me talk about in other videos that if the underwriting system does not give us a pass, you could still do it through what's called a manual underwrite. That is 100% true. That is absolutely accurate. However, when you go from an automated approval to now needing a manual approval, it's higher scrutiny, which means that lenders can add on additional rules and requirements on top of the handbook that was already at place had you gotten an automated approval. So my point behind this is, even though you may be able to or may not be able to get that automated approval and go the manual route, it is tougher to go the manual route with a high debt to income ratio. Typically, when going the manual underwrite direction, most lenders that I have seen will require anywhere between, some require 55% or less debt to income ratio. I've seen some at 60, and I've seen 1 or 2 at about 65. So I would just keep that in mind here in this situation. Now, I want to dive deeper into this. What if this veteran did not have property taxes, right? We remove property taxes, our payment drops by over $200 per month, which then means our debt to income ratio drops to 75%. So it just makes the situation better for this particular veteran and in their ability to qualify. So we come back to the VA loan analysis and they're at the 75%. They meet residual by $1,449. That's one route we can go here. But I said earlier, what if you're a veteran that has employment instead of VA disability, or maybe a portion thereof? So what I'll do is I'm going to say that you may be, let's say, $5,000 per month. Okay. So what I'll do here is I'm going to put in base employment. I'm going to put in that is to be determined, enter in a bunch of numbers here. And let's say that you have been at your employer for at least next 2 years. Okay, I'll just put October 1st there. And we're going to do a base salary per month of $5,000. Okay, and we'll hit save here. But we still have our VA compensation in there. I'm going to drop it down. I'm going to put that our VA compensation. Actually, you know what? I'm just going to take it out. Now I want to leave it like that for a second so we can come back to it later. So now VA compensation says 0, even though I have it listed in the notes. It's just doing that so we can come back to it here later, okay? So now we have our debt to income ratio with that income at 72%, but there's something else that we need to do here. Remember, we need to come back over to our VA loan analysis. We'll remove the amount that we grossed up. And what we have to do now is we have to factor in monthly taxes. Remember, this is not going to allow the same abilities as a veteran that has just VA compensation, because with employment, you have taxes, right? Those taxes are based on federal, state, Social Security. So we have to keep that in mind as well. So I'll bring up a paycheck calculator here. This is what I like to use as a paycheck calculator. And it just gives me the ability to put in what I need and tell me what should be factored in for those different things. So we'll do per pay period. We will do on a monthly basis, and we will hit calculate. And it's going to tell us what that number is. Perfect. So we have our federal withholding of $430.13. So, and I know Texas, there's no state withholding, so that's 0. Social Security at $310, and Medicare $72.50. All right. There we go. So now we have that factored in at $5,000 a month. This is what that would look like. 72% debt to income ratio. Actually, it's actually a little bit lower, but remember, we had to factor in those monthly taxes here. So this is what the numbers would look like, guys. I hope this video is helpful to somebody out there and gives you guys a better idea of what to expect. If you want me to do more payment breakdowns like this, let me know down below in the comments. I'm happy to do it. Last thing, most important, don't ever forget it. Jesus loves you, and he paid the ultimate price for your life. So if you turn to him, trust in him, and believe in him, he has a beautiful plan and purpose for you. I'll see you guys in the next one.